you've advised companies that were looking to go public. How would you advise some of these names that are now in the pipeline today?
Thank you for having me this morning. It's great to be with you. We have about 600 folks across our practice in the U.S. that are working with companies looking to go public. And the first beginning of this year, we were a little worried about how this full year would play out with the government shutdown. But, you know, we're already ahead of last year's pace, just barely, but 78 IPOs versus 76 last year. We're more than halfway there in terms of what was raised last year. Obviously, we've had some chunky deals. And lots of folks right now are asking us, you know, how do you feel about the balance of the year? And I'd say, for the most part, we feel pretty good about that. I think there's been a valuation sort of people looking at valuation again to say, where are we, particularly in the tech space? So I don't think that's all bad, frankly. The more rationality we have in the market, the better it is. There was a point in time this year where we were a little worried as we saw companies coming to market. Nothing was pricing below the range. And now we've had about 15% of the companies priced below the range, 70 in the middle, 15 above. So that feels pretty good. And on balance, the market seems to have been able to shake off macro concerns like Brexit or China growth or even interest rates, which obviously is on everybody's minds right now.
Yeah, there's been a lot of uncertainties in terms of the macro picture. Phil, the valuation really kind of shakeout we've seen essentially with some of these bigger tech names that have gone public recently. How would you assess that?
Well, I think what we want to see is general stability. Right? I think it's a good long-term question to ask. What would we as society like the price post-IPO, 6 months after IPO, a year after IPO to be? And the answer is we kind of want it to be generally flat, maybe a little bit up. Right? Anything that's too much one side or the other shows some hype, some inefficiencies, some potential problem. And if we're looking at the general performance and the general evaluation right now, it feels okay. Maybe a little bit on the too high side, but not too much. And I like that there's this mix, that things are trading within a band that feels rational. In terms of the actual valuations, I think this makes sense. I think companies are going public later than they used to, just because there's much more options in the late-stage private markets. So it makes sense that the general valuation would be a little bit higher.
David, Google announced, Google Cloud, that it's buying Looker this morning, a business intelligence firm, for $2.6 billion. Its valuation back in December was $1.6 billion. What should investors overall read into that, given what we've been saying about valuations?
Well, what I read into that, John, is a healthy market, and we're going to see companies look at two paths. When they're thinking about going public, they're going to obviously look at the public market hard and think about what it's going to mean to be a public company and to execute against your numbers that you're projecting there, and then look at the potential for joining a larger enterprise like a Google in the context of a sale. So this is pretty typical. And we've seen some terrific companies get taken out of the IPO flow through M&A, but I think that's healthy. And when you look at VC portfolios over time, generally speaking, 8 out of 10 are going to be sold. They're not going to go IPO. So for me, it's just a healthy sign of where we are in the market.
Wow, 8 out of 10. That's quite a number right there. Phil, I'll put the same question to you. How would you assess this Google deal today?
Yeah, I think it makes sense. I think one of the side effects of a lot of companies that do go public, going public later in their stage, like Uber, is that it does drive up the kind of the average value, and so it makes an IPO a little bit less attractive for a company that's going out, that's thinking about an IPO, maybe at the stage where companies 5 years ago would have been thinking, maybe a couple of $1 billion. So I think we'll see more acquisitions in kind of the lower range. The range that used to be considered healthy IPO range is now healthy late stage acquisition range, and the desired IPO range has been bumped up now into the closer to 10 billion or above level, which is fine because there's really not that much of a difference between being acquired and going public in terms of the results, returns to initial investors, to founders, private shareholders, and so on.
David, behind me we have GSX. It's the latest Chinese company here to go public today.
Yep.
In terms of some of these non-U.S. companies, especially given the fact that we do have these flaring tensions around trade dynamics right now, would you expect to continue seeing some of these, particularly Chinese tech names, coming here to make their offerings?
Well, it's a great question, Morgan. I would say that it wouldn't surprise us if you saw a bit of a slowdown in the companies from China coming over here. To date, we've had about 17 or 18 companies, non-U.S., come here to our markets. That's roughly 22% of the flow so far, so up from our sort of 10-year average around 15%, a little south of where we were last year when we were at 25%, but healthy. And it's not just from China. You've got companies from Russia, you've got companies from the UK, you've got companies from Latin America. So there's balance there and geographically, but it wouldn't surprise me if there's a bit of digestion that has to happen on the Chinese front as we look out, and maybe it'll be latter second half of this year as opposed to this summer.